And welcome back to the show this morning at 6:33 on your Hump Day edition of the Lance Roberts Show. Michael Lebowitz, the certified, he's certified for sure. CFA.
Certifiable.
Exactly. Join us this morning. Hi, Mike. How are you?
Doing great. Thanks for having me.
Absolutely. So just for the break, we're talking a little bit about, a lot of the falsehoods that are put out in a lot of the mainstream media about the basics of economics. We don't teach economics to our kids, so they don't really understand when they hear, certain statements made, they don't really understand, what that means and how the data can be manipulated to basically show you whatever it is that you want to hear. But understanding how things really work are important for understanding, A, if you're going to go vote for somebody to run your country, understanding the basics of economics will help you make a better decision about what they're promising and the viability of them doing that. But the second thing is to understand that what policies you vote for are ultimately going to be viable or not, because you're going to wind up paying for them. And you pay for these policies, right? It sounds great. We're going to do, as I was saying, the example, free college for everybody. That's great. Somebody's going to pay for it. And it's going to be you when, great, everybody else is getting free education. You're going to be out there working for it, and you got to pay you got to pay for that free education through your taxes. And and again, the point is you're paying for everybody a free education, but you're destroying the value of education by doing that. So, supply and demand, the basics of economics are very, very important to understand. Here's another myth that's thrown around a lot as of late. China owns all of the U.S. because they're buying all of our debt. And that's not really true. Yes, they hold about $1 trillion worth of U.S. Treasuries, but they do that to sanitize trade between the U.S. and them, right? Because all transactions occur in U.S. dollars, and they have a choice. They can either take the dollars back into their currency, which would make their yuan much stronger relative to the dollar, make products more expensive to import into the U.S. So they sanitize trades by leaving dollars in treasuries in order to keep the currency exchange rate somewhat stable to benefit trade. It benefits consumers and exporters at the same time. But the real issue here is that a lot of people have been saying in the media is that, China's buying all of our treasuries. And that's not true. Michael Lebowitz joined us this morning. He's just got an article out on our website this morning, realinvestmentadvice.com, with some pretty interesting insights into actually who has been buying all of our treasuries. Mike, what'd you find out?
So first of all, for the last 15, 20 years, let's call it 2000 to the year 2015, we, domestic buyers, and that includes mutual funds, pension funds, endowment funds, you and me, hedge funds, any type of investor, a lot of which are individuals like ourselves, bought less than 25% of U.S. Treasury bills. That means we funded less than 25% of the debt of Uncle Sam, essentially. Mm-hmm. Over 50% of that was funded by countries. China was a big one. Japan is a big one. But almost every country, like you said, Lance, holds reserves. And you can think of those reserves sometimes to sanitize trade, but a lot of times it's like your wallet. Mm-hmm. You have an extra couple bucks in case you want to buy something on the spot, or you keep a small amount of money in your checking account that earns zero for purchases. So just about every country has dollar reserves because they trade in dollars. So about 50% of our debt, or what Uncle Sam has spent between 2000 and 2015, was funded abroad. So that means while we were spending, let's just say $500 a year, we were only paying about $150, borrowing about $150 from our own citizens. So to some degree, it was a free ride. Mm-hmm. And starting in 2016, that equation changed drastically. And it's very concerning to me. First of all, a couple of things have happened. As you know, in 2008 through 2013, the Fed started buying treasuries. So they were essentially taking debt out of the market and essentially a buyer of U.S. Treasury debt. So they were helping alleviate or helping fund some of the debt. But more concerning, since 2016, net foreign purchases have barely increased. So they still have, their size of their wallet is still the same, but it hasn't increased. And yet at the same time, our deficits continue to go up and up. Our Treasury issuance over the last year was over $1 trillion. So where we're coming at is with foreign countries not necessarily selling, but not buying more. They're just holding steady, and the Fed is going to stop QT. I'm sorry,
Hmm.
which they're currently doing QT, which means they're actually getting rid of treasuries, which
Right.
is worse. But they're not going to be doing QE, so they're not involved. That means basically 100% of the onus of our debt is on ourselves, which is the way it should be. We should be responsible for our own debt. But the problem is we're issuing over net $1 trillion a year, which means we have to come up with, as citizens, as pension funds, as mutual funds, that $1 trillion to fund the debt. And that's money that's not going elsewhere.
Yeah.
It's not going to buy stocks. It's not going to consumption. It's not going towards investment to make our economy stronger in the future.
Right. Yeah, and I think that's a real key point here. And just to clarify what you're saying, is that every year. So, for instance, we're about to come up on a new budget cycle, right? So, September 30th, the 2019 budget for the U.S. government ends, and we have to then start into the 2020 budget October the 1st of this year. And that's just the way the government runs. So we're about to come up with a new continuing resolution because we don't have budgets anymore. We're going to come up with a new continuing resolution for $3-4 trillion to fund the government through the entirety of 2020. Well, that's new issuance, right? So we're not talking about existing dollars. We're not talking about the existing spending, et cetera. This is new bonds that have to be issued to fund the difference between what we bring in tax revenue versus what we're spending. So if we bring in $2 trillion worth of revenue through taxes, and we're going to spend $4 trillion, that means we have to put $2 trillion out in new bonds to pay for that difference. And that means somebody has to buy those bonds. And as you were saying earlier, historically, about 75-80% of that was bought by foreign countries in order to do trade. Over the last couple of years, U.S. citizens and U.S. buyers of some form have been buying 100% of that new issuance. And the question then becomes, if the U.S. buyer stops buying treasuries, what happens if nobody else is buying the new issuance?
Well, someone will always buy it. There's a price for everything, and U.S. Treasuries are considered risk-free. And whether you believe they're risk-free or not, they're still at the top of the risk food chain, meaning they're the safest thing out there, at least for now. So there's a price. There's a price for everything, right? The question is, at what price and how much will that cost? Because the U.S. Interest expense is rising sharply simply because of the amount of debt, and rates have risen a little bit, but the amount of debt continues to shoot up pretty quickly.
Right.
And that just means we have to issue more debt. And if no one abroad is buying that debt, it means again that onus is upon us to buy the debt, and that money will not go elsewhere where it can actually help.
And let me clarify what you just said here, because I think this is the most important thing, is that the amount of money that we spend on Social Security, Medicare, Medicaid, prescription drug benefit, and interest on the debt consumes about 80 cents of every tax dollar that we bring in. That's on an environment right now where we're issuing new debt, but the rate on that debt has been falling. We're currently about 2.2% on the 10-year Treasury, which means that right now we're able to borrow a lot of money fairly cheaply. The problem becomes if nobody shows up to buy that debt, as you said, price determines everything. And if somebody shows up and says, "Yeah, I'll take your $1 trillion in new debt, but I don't want it at 2.2. I want it at 4, or I want it at 5%." All of a sudden, not only does the debt, the interest rates rise, which affect everything through the economy, from, purchasing a home, purchasing an automobile, your credit card interest, et cetera. I mean, consumers get hit with higher rates right where it hurts the most in their pocketbook. But it also means that the government will spend dramatically more money on servicing the interest on the debt, which is going to consume even more of every tax dollar that comes in, leaving less and less and less to do things like infrastructure, productive investment, et cetera, in the economy.
Right. And this is what we've been doing for 30 years, is borrowing too much. And now it's coming back to haunt us. We have to pay our own debt. And now that's money that has to go to paying back debt and paying for new debt that can't be invested. And that's a huge point, Lance.
Be right back after the break. More with Michael Lebowitz. We'll finish up on this topic and get you ready to start the day. Don't go away. More of the Lance Roberts Show coming up. RealInvestmentAdvice.com. The article that Michael wrote is on the website now. Who funds our debt? That's on our website now. Simply go to RealInvestmentAdvice.com. You can read the whole article. It's a great piece. Got some great charts on it for you to help you understand how this actually works within the economy and why it's so important. Because it's either you vote for better economic prosperity down the road or you vote for Joe Biden to cure cancer. It's one of the two. We'll be right back after the break.
Want a longer talk with Lance about your money? Request a personal one-on-one at LanceRobertsShow.com.